Welcome to this week's live ASX strategy session. Thanks for joining me. Great having you with me for another show. Heaps of interesting things to talk about this week with some developments in the market, some breakouts in silver, in copper, lots of interesting things going on. And of course, all your stock codes, any stocks you'd like to have a look at on the charts, get those stock codes ready. We'll go through those in the second half of the show. Now, as always, everything today, general commentary only, doesn't take your personal situation into account. Having been through all of that, let's get into today's first chart. And starting off with the ASX 200. And well, the ASX 200 can't seem to find a way higher. It's been capped for over a week now. So are we about to get a retest of the lows? More on this in a moment. And then over in the US, there's been some important developments this week, and it's all been happening against an unusual backdrop. I've got a graph for you that I think will surprise you, and I'll show you that shortly. But first of all, let's just start with this latest price action here in the ASX 200. So the first thing to note is that the ASX 200, it remains stuck below this overhead resistance at around 8,600. You can see this blue horizontal goes over to a previous all-time high from February and some other technical activity along the way. And now here we are. It's been stuck here for the last week. And it's basically been unable to build on its gains. So it's been able to build on these gains off the November low. And when we get these situations where a rally's capped, and then you pair that with a market that has these moving averages rolling over, that can often set the stage for trouble. But I don't think that's the situation that we have here. And so, yes, the ASX 200, it is consolidating below these declining moving averages. And when that happens, that typically increases vulnerability. But I don't think this is setting up. I don't think this is setting up for a sell-off. So just look at the price action over the last week. What we've got the ASX 200. It's been sitting quietly. It's been sitting quietly just below this resistance at around 8,600. And in doing so, what it's been doing, it's been holding onto its gains off the November low. So you can see you had a strong rally off the November low, and then the last week and a half, it's just been holding onto those gains. So I think that's a positive. It's always a positive when the market holds onto gains. Now, this is important. By holding onto its gains, it suggests that the dip is currently being bought, and importantly, the rally is not being sold. The biggest vulnerability below the moving averages, when you get these declining moving averages, the biggest vulnerability below the moving averages is where the rallies are sold. And that's not the price action that we have here. This price action isn't suggesting the rally's being sold. So are we about to see a break above 8,600? Is the market about to push higher? Well, I think it's worth looking at two key components of the local market, starting with financials. So this is the ASX 200 financials index, and this is exactly the sort of price action that I was hoping to see. Last week we spoke about this shallow bounce. So see, we had this shallow bounce that really wasn't attracting much buying, and we talked about how a shallow bounce off a lows it sets up vulnerability. And it looked like the financials were about to retest their lows, which in fact they did. They retested their lows during this week, making a marginally new low on Thursday. So this is a type of price action that really is especially vulnerable, and that is where you get a bounce that doesn't attract strong buying, and then eager sellers come in and they offload into any strength. That's where vulnerability really sets up. As we saw that play out in the financials last week, a new low on Thursday. But this is where it gets interesting. Look at Thursday's price action. Let me just expand this for you. So here's Thursday's price action. So prices opened. They traded lower through the morning before reversing and then closing up on their highs. It's only one day, but it's an early sign of seller exhaustion. And I think it opens the door for a larger rebound back towards the moving averages. So when prices make a new low and you don't get the follow through selling and instead they push higher, it's a sign that the selling has really run out of steam. The sell-off from October's high, so we take October's high. So this sell-off from October's high, it's also proportional to the rally off the April low. So here's our April low, strong rally, and now we've got that pullback. What we can do, we can put some Fibonacci retracement levels on. That gives proportion. And when you use the low point, you take it through to the high point, you get this green shaded area there. That's the Fibonacci retracement area. Just Google Fibonacci retracements if you want to get more detail. But basically, it's a region where markets often pull back from. It's a proportional type of pullback. And what we have here so far is the financials have come back to the upper end of the Fib region. So rather than this being the start of something dire, I think it's more likely a pullback within a big upward trend. And this has been a big upward trend in financials for quite a while, notwithstanding corrections and lengthy sideways periods in between. But it's been this general big upward trend, which I think still remains intact. Nothing here suggesting that this big upward trend has changed at this point. The next step, I think, is to watch what the next rally looks like. If we do get a rally, that is, of course, if we get a rally, what does it look like? Is it strong or is it lackluster? Like strong would really see it punch back towards the moving averages. Lackluster would see it just languish, and that sets up vulnerability. Ideally, it's strong, and that would indicate buyers are returning. The next step is for prices to re-establish above the moving averages. It may not be a case of a quick return to new highs. I think that may still take a bit more time. But if financials can rally from here, financials can lift off their lows back towards the moving averages, I think it removes a weight from the ASX 200. And I think it clears the path for the ASX 200 to break above that 8,600 level that we were speaking about. Coming over to the materials index, so the other big part of the ASX 200. So we've got a breakout and a new all-time high in materials. And of course, this is where the big miners live. And the thing about all-time highs is that all-time highs tend to lead to more all-time highs. We can just compress all this, and you can see this is let me just briefly whack this on a weekly chart. And there you can see this goes back to the 2001, and there's our all-time high in materials. And all-time highs tend to lead to more all-time highs. This week's rally has been a continuation. It's been a continuation of the rally off the 50-day moving average, which we were talking about last week, and that's also led to a breakout from a 6-week range. So we spoke about this over the last week or two. We had a 6-week compression into the moving averages. Now we've got a breakout from that range with the latest price action. I've seen several motion trader buy signals for big mining stocks this week, as well as some of the mid to smaller ones. And with materials strong and financials potentially turning, I think that provides a good backdrop for the ASX 200 and the broader market generally. Just quickly coming over to the equal weight, the ASX 200 equal weight. And this is what we have here. This is not a vulnerable structure. Despite all the talk of interest rates possibly rising, despite people concerned about the market, the equal weight remains in an upward trend. Like this is an upward trend, and that upward trend remains intact. Just look at the rally off the November low. So there's our November low. Look at the rally off that low, and that's a strong advance. And since then, we've had a shallow pullback. We've had a shallow pullback over the last, say, week and a half. And so what that says, a strong advance and a shallow pullback, that says buying of the dip is in action. Prices are also on the right side of the moving averages, so they're above moving averages. That's always important. This tells us the broader market is doing well, and that it's not just a rally in a couple of the big mining stocks. And it's not just that propping up the market. For the equal weight to be above moving averages, you've got to have that broad participation. And that's what I think we have here. Quickly coming back to the ASX 200, I'm continuing to treat this as a pullback within an uptrend. And I think the odds favour the next move is a rally back to the moving averages and then above the moving averages. I think that's what we're more likely to see, not a breakdown to new lows. I don't think that's the scenario that we're currently looking at. I've been seeing some interesting buy signals from my Motion Trader service this week. You can get a free trial of that in the description section below if you'd like to see for yourself. Overall, this is a market I want to remain long. I don't want to be sitting on the sidelines waiting for uncertainty to pass. I think that's a mistake. I think people like to sit on the sidelines when they think things are uncertain. But what I've found over the years is there's always uncertainty. There's always something to worry about. There's always the next problem on the horizon. I'd rather buy stocks that are breaking out, hold stocks which are in uptrends, and then use wide trailing stops to manage risk. It's about having a plan to participate and then having a strategy to sell if things take a turn for the worse. That's the way I'm approaching this market. But it's hard to move forward without that plan to participate. Okay, we're going to move to the US market now. If you're getting some value from this, please click that like button. Tell me what you think. Do you think we're about to break out or break down? And but yeah, definitely leave that. Click that like button now while you're thinking about it, because it helps me heaps. YouTube shows other people. If people are watching, I can make the videos and do the strategy sessions. So yeah, do those things. It does help me a great deal. Okay, so let's now go over to the S&P 500. There have been some interesting developments in the US this week, and it's all been happening against an unusual backdrop. I'll show you a graph. I'll show you that graph I mentioned in the opening in a moment. But first, I want to take you through a scenario for the S&P 500. What we have so far, we've got a 5.7% pullback to the 100-day moving average, from an all-time high to the 100-day moving average, 5.7%. It's been a fear-inducing pullback, like all pullbacks tend to be, and it's now been followed by a strong rally off the moving averages. It's interesting to put some perspective around this pullback. The latest pullback, this is the 31st pullback of more than 5% since the GFC low in 2009. If I can quickly, I had to just quickly put this on a weekly chart to see you to show. So from 2009 to where we are now, this is the 31st pullback of more than 5% since that GFC low. Now, some of those pullbacks, some of those sell-offs got a lot bigger. Of course, the COVID crash is included amongst them, but 20 of those 31 were between 5 and 10%. So you barely see them when you look at a chart like this when it's all zoomed out. And many of them didn't get much bigger than the pullback that we're currently looking at around that 5 to 7% sort of mark. So the point is that pullbacks happen, and most of them don't lead to long-lasting declines, although they almost always seem to involve considerable fear and uncertainty. This one is no different. And I think the only difference this time, it's the theme. And the theme this time, it's fears about a bubble in AI. Every time there's a 5% pullback, there's a theme that people are worried about. And maybe this develops into something larger. But at this stage, I think it has the characteristics of a pullback within a rising trend. And I think this latest rally off the 100-day moving average, I think it's encouraging. It's been a strong rebound off the November low, and importantly, the S&P 500 is doing a good job at holding on to its latest gain. So that's a sign the dip is being bought rather than the rally being sold. Prices are also above the 50 and 100-day moving average. The red one is a 50, the blue average is the 100-day. So prices are above those, which is, of course, the underpinnings of a bullish trend. So I think while that remains the case, I think we should be favouring higher levels, not looking for a reversal. Going over to the equal weight, the S&P 500 equal weight, same sort of setup is playing out here. Prices are above these moving averages, which are rising. The equal weight is also showing that this is broad based. This is not just about Nvidia; it's broad based. You've got to have a lot of those top 500s participating to have the equal weight rising, particularly having it rally strongly. The added insight we get from the equal weight, it's this false breakdown that we had a few weeks back. So prices broke down from a two-month trading range. Just in here, we had a 2-month trading range where prices were moving sideways. We got a breakdown about 3 weeks ago, but that breakdown didn't attract follow through selling, and when you don't get that follow through selling, that's a classic sign that it's a market where buyers remain the dominant force. And when fear is in the air and a breakdown fails and prices rally, I think it tells us that the path of least resistance remains up. That doesn't mean that we're going to see prices just charge off to new highs in the next week. Like this general pause we've had in momentum, it could still take a bit more time to play out. I'll show you what I mean. Just coming back over to the S&P 500. So one scenario is that maybe we could see some more backing and filling over the next few weeks, and from there, then that could potentially lead to a breakout in late December. So maybe some sideways followed by a late December breakout, and that would play into that Christmas rally theme that we often see play out. I'll show you an example of the sort of price action I'm talking about. I'm going to jump over to the transport index. We don't usually look at this, but it's interesting to have a look at this. So let me just move back in time a little bit. I'm looking at a different time, but I'm looking at price structure. That's the point of this, looking at price structure. Now, this is an ETF that tracks a US transport index, and so just look at this section here. It's similar to the current S&P price action in that there's a high followed by a pullback to the 100-day moving average, followed by a strong rally. And then after that strong rally, rather than then quickly then continuing upwards and onwards, it was a case of the transports tracking sideways for a period around the moving averages before eventually breaking out. It happens to have been just in the last few days. But maybe we could get that sort of price action develop in the S&P 500, maybe on a shorter time frame. So maybe there could be that late December rally. But nonetheless, it's the fall to the average, the rally off it, and then rather than continuing up, maybe we get sideways before up. Just on the transports, I think this week's breakout, because you can see the transports were trading sideways in this range. We've now got a breakout. I think the breakout in the transports is generally bullish for the overall market. And that's because when transports are doing well, it's a sign of activity, or it's a sign of an active economy because things are being moved around. And so rather than getting fixated on whether there's a bubble in AI, I think it can also help to look what's happening in other parts of the economy. We don't normally hear about the transports, but look, there's a breakout. And it's just on the it's just either at or just on the doorstep, I think, of an all-time high. So it's interesting what's going on elsewhere. Okay, I've got a graph for you. It's not what you'd expect to see at all-time highs. Let me show you this. Turned up on my X feed through the week. It's at the University of Michigan Consumer Sentiment Index, Goes back. It's long running survey. It goes back into the 1960s, into the 1950s. Look where it is now. It's down here. It's bombed out near a record low, and that's interesting. And it's interesting because lows in sentiment are generally associated with recessions, with weak stock markets, just general malaise and unpleasantness. And but we've got markets at all-time highs. So, and you can just look along this graph. You can see like these low points. There's the GFC lows and the recession, the depths of the early late 90s, the late 80s, early 90s recession. 80s recessions are in there. The 1970s was a pretty grim period, and then you go along and you look at and of course, these are all notable low points in the stock market. Then you think about, okay, where the big highs in the stock market been? Well, there was leading into COVID, that market was at record highs, and then you go back to just prior to the GFC, which is this period in here. Times were good, markets were high. Prior to that, we had the peak of the dot-com boom. Things were positive. We had the mid to late 80s. Things were good then. Then you go into the 70s, there wasn't too much good, and the sentiment index never gets too high. 60s were generally a good time. So, it's interesting to take this in. The other thing of note is that look at it. It's a fairly rhythmic sort of graph. It broadly swings from highs to lows and back to highs. The cycle would suggest that where things are now, the cycle would suggest that things should at some point start to swing back up towards highs. What would be the cause? What would be the catalyst for that? I don't know. Don't know what sparks that. But generally, if we were to see rising sentiment at some point, that would probably be a good thing for stock markets. And this isn't a timing tool by any stretch. It's more an overall backdrop to keep in mind. And just remember that history suggests that gloomy sentiment is not a good predictor of troubled times ahead. It's more rear view mirror type stuff. So look, just something interesting to be aware of. Okay, so that wraps up. We're going to move over to the small caps now. We'll do the US small caps. We'll do the Aussie small caps, copper, gold, oil, uranium. I've got silver in there this week. So lots of interesting things to go through. Of course, that wraps up the free section. If you're not a strategy session member, there's a link below. Click that. Coming in, we're going to go through heaps of stuff. Get your stock codes ready. We can go through them as well. I think you're going to really enjoy what we have in the second half of the strategy session. All right, so going over, let's go over and start with the US small caps, the Russell. Here we go.